Good day, fellow investors. Jeremy Grantham is out with a new letter and a super bubble warning. So Jeremy Grantham from GMO says how the current super bubble is a 3 sigma event or greater. For those who don't know Jeremy Grantham, he has correctly predicted the Japanese equity bubble, the dot-com bubble in 1999, the 2007 global financial crisis or the housing bubble more specifically, and he is now predicting an equity super bubble that will destroy 45 trillion in US wealth only. So let's dig into the details, see what's going on, why is Jeremy Grantham warning us of this immense super bubble about to burst, and then conclude with what to do as an investor looking for doing well with your money. The structure of his letter is, of course, defining the bubble and the super bubble, the dangers of multiple asset bubbles, because we now have not only stocks, we have commodities, bonds, housing, low interest rates, so there are multiple asset bubbles in the making. How did this happen? Why does the Fed inflate bubbles and doesn't do the opposite? Of course, a touch on inequality, what has been going on, some last minute color on the market frenzy, where are we now in the market and why it's likely we are close to the bubble popping, and what to do as an investor. If you like this video, please smash that like button and consider subscribing. Now let's start with bubbles. What is a bubble? The definition of a bubble: a normal bubble that happens every few years here and there depending on the asset class, is where something is priced 2 sigma, 2 standard deviations from the long-term trend. A super bubble is 3 standard deviations from the long-term trend. Let me explain with this chart. So this is the S&P 500 price index, and you can see the dot-com bubble, the housing crisis, and since then something strange happened. There has been an explosion in the stock market, and this is a deviation from the long-term trend. This is what would be the long-term investing trend. Of course, stocks slowly and steadily go up thanks to inflation, reinvestments, economy growth, and Jeremy Grantham says that the trend at 2021 should be around 2,500 points for the S&P 500. But of course things are different after, if we omit the COVID blip here, after 2008, money printing, low rates have pushed the stock markets to really crazy highs, and this cannot be accepted as normal. Therefore, 2 or 3 standard deviation is what we are looking now, and Jeremy's message is that this always, all the bubbles in history have reverted to the mean or even went below the actual mean or long-term trend as people in panic sell and the situation gets really bad also from an economic impact. As we now have a trifecta of housing, bonds and stock prices that are inflated, then the trifecta bursting might lead to lower than trend values. That's the negative scenario for investing. So not only stocks, we also have housing bubbles. Not so much in the US, as it is a bubble, definitely Australia, Canada, Europe, so that's also something to watch. If we look at the United States home price index, so 2000, and then you look at the trend, and you can see the house prices diverge from what would be, let's say, a trend. We are now 12 years beyond the housing crisis, and the index that takes the average of all, also the real estate that are located in the middle of nowhere, is more than 50% up. Then this was a terrible situation 15 years ago. Now it's higher and nobody cares. Also, another indication of a bubble is the allocation to assets, to stocks. When stocks go higher and higher, people tend to have more of their money invested in stocks because stocks can only go up. And this is the current predominant position in, let's say, the market's thinking that the stocks can only go up, and consequently stock market allocation is at extreme highs because, as we said in the asset class overview investment video, what is the alternative? There are no alternatives. So it's better a 2% dividend yield than 0 in a bank, which leads to the bubble going from 2 sigma to 3 sigma, becoming a super bubble, but eventually, if history is a teacher, should revert to the mean. And if we look at the US stock allocation, you can see that stock allocations is more than 50% now, while in 2009 it was 25% when stocks were a lot cheaper. 2000, again, stock allocation 50%, and then as stocks decline, people sell even more than what is the decline. So when stocks are cheap, people don't like stocks. When stocks are high, people are crazy about stocks, like it was in the 60s, late 90s, 2000, and of course now everyone is talking about stock markets. YouTube channels are growing like mushrooms after a big rain, so that's another risk there. Commodities, food price index is exploding, so this is a huge jump, 50% up for food, and this has great repercussions globally, so that's also something that impacts what's going on. Less consumption, thus less earnings in the future, and you just need to go to the gas station, fill up your tank, or of course you're driving a Tesla, then look at your electricity prices, and then you will see that, okay, this is also a commodity bubble or inflationary situation, one or another. And the high prices of commodities are important because they push inflation and stress real incomes. And that is also something that we have seen in 2008, Jeremy Grantham says, and that is the ultimate pincer attack on the economy, and it is all but guaranteed to lead to major economic pain. Also, this multiplies the risks. They say that in 2007 they expected a 10 trillion destruction of value, which happened only for housing. Now imagine what can happen from equity bubble, housing bubble, commodity bubble, bonds bubble. We just need to take a look at bonds and yields on the 10-year US Treasury, and you can see that the yields have been going just down, 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 and down even lower at COVID crisis, and now they are a little bit up, but historically, what happens if this reverts to the mean, which is, the mean is 5%, we are at 1.8%, that's huge destruction for bonds too. So what are the tips from the first part of the message? Of course, the higher an asset price is, the lower is your expected long-term return. That's simple mathematics, and therefore we shouldn't be happy when asset prices go up because our long-term returns will be lower, especially if we are still adding to our portfolios. And the higher we go, the longer will be and the stronger will be the pain to endure as things revert back to trend. In the current case, the trend, according to Grantham, is 2,500 points for the S&P 500. Then there is a poke at the Fed, and that the only lesson that the economic establishment appears to have learned from the bubble of 2009 is that we didn't address it with enough stimulus. So, as Grantham says, the Fed settles for more lifeboats rather than iceberg avoidance. And of course, another poke, Iceland, population of 300,000, sent 26 bankers to prison after 2008-9. The US population, 300 million, sent 0. And then again, poke at Bernanke, how he said in 2007 the subprime mortgage woes won't seriously hurt the economy. If you hear the Fed now, nobody is talking about asset bubbles. Also, inequality, look at how these low interest rates have pushed inequality higher, higher, and higher. Also, spending as share of income after tax is focused on the bottom 90%, so as inflation curbs this income, also it will hit earnings, margins, expectations, and growth. Also, financial assets make most of the wealth there, which is another risk if this returns to the mean. So the consequences are inflation. When pessimism comes back, you know what happens to asset prices. So that's inevitable when the cycle reverts. Eventually, the cycle will revert. We don't know when exactly. Jeremy Grantham says it will happen soon. And the total wealth destruction is expected to be at least 35 trillion. That's almost 2 GDPs for US, 2 yearly GDPs. And the destruction will come. If the stock market reverts to the trend, that's 17 trillion destruction. You can pause this one and read this carefully because this is really important. Then we have real estate worth 41 trillion. If that reverts to the mean, and in US they say it's not really a bubble, but it has to revert, so that's 11 trillion loss. Again, bonds, a 6 trillion loss for the bond market. This will hit consumption, this will hit economies, this will hit everything. And if this negative wealth and income effect is compounded by inflationary pressures from energy, food, and other shortages, we will have serious economic problems. And now on the crash, bubble bursting, that usually starts with indications like it did in 2000s when the craziest, the risky businesses started to falter. We have seen that with ARK ETFs that we discussed a year ago as risky. They haven't had a good year, and that's one indication. Then we have here a blow-off before the burst, and we have just had that blow-off with a remarkable performance by the S&P 500 in the last 2 years. Plus we have more crazy behavior. He mentions Mimi, Madness, Dogecoins, Hertz, Bitcoins, and if we look at Bitcoin, we can see here it going down and down, and you never know with Bitcoin. There is so much noise into this that it's simply impossible to predict, but this is also a trend. If it continues, it can end ugly, of course. More specifically, if we look at non-profitable tech stocks, you can see how the performance has been very bad in 2021, while everything is narrowing into the top names, which is again an indication of a bubble. So the death of the vampire, Grantham calls it, how you throw everything at it at the bull market, COVID, quantitative easing ending, higher rates, then we have unexpected inflation, and the market just keeps on going higher and higher like a vampire. And then you just start thinking the market is immortal, and finally, perhaps a little anticlimactically, keels over and dies. The sooner, the better for everyone. And speaking of the bubble, many will say PE ratios are not that high, and Grantham addresses that by saying today's bubble depends on ignoring 100% of current inflation. If we look at predicted price-earnings ratios and realized price-earnings ratios, then you see here the divergence, the super bubble of the 1990s, and here you see realized PE ratios diverting from those that were predicted, because there are impacts on those earnings, those margins, and sooner or later those might also revert to the mean. And if you look at the PE ratio, is just 1 and something standard deviation, but if you look at the cyclically adjusted price-earnings ratio, the Shiller PE ratio, you can see that it is far away from the mean. This is 2-3 times standard deviation, or really super bubble like it was in the 2000. So rules of the bubble reviewed. All 2 sigma equity bubbles in developed equity markets have burst all the way back to trend. The US reached the 2 sigma level in summer of 2020, 3 sigma in late 2021. It is uncertain when you will get 3 sigma super bubbles, yet they all have shown certain characteristics before they broke. speculative investing frenzy, penultimate blow-off phase like we had in 2020, and the ultimate narrowing phase unique to these few super bubbles, where a decreasing number of very large blue chips go up as riskier and more speculative stocks underperform or even decline, as they did in 1929, 2000, and as they have done since February 2021. Of course, what to do? Jeremy Grantham says value, lower PE ratio, lower PE ratios than the US, look globally. He looks at small caps, Japanese. I'll be looking around the world to find better opportunities and also looking at the risk and reward globally. I feel that it's inevitable to get hit when this bubble bursts. The key thing is to survive the bubble bursting as good as possible, and then to build yourself strength so that you are going higher longer term and compounding at a higher rate. On Jeremy Grantham strategies, there is the long-short strategy, shorting the high-risky tech ones, going long value, or focusing on thematic things, value specifically. We'll discuss more about that during the year, and for next Saturday, I'll prepare Safe Haven from Mark Spitznagel, great book about long-term investing, protecting yourself. So for now, subscribe to the channel, smash that like button, and I'll see you next weekend with more about strategy on how to protect ourselves so that whatever happens, whether Jeremy Grantham is right or wrong, we do well.